Today, we're diving into a stock that pays dividends every single month and invests in the booming healthcare sector. Healthpeak Properties, ticker symbol DOC, currently trading at $17 per share. This is a real estate investment trust, or REIT, that specializes in healthcare properties including medical offices, life science buildings, and senior housing facilities. With a market cap of $12.63 billion and membership in the S&P 500, this is a major player in healthcare real estate. Analysts have a buy rating with a price target of $20.55, suggesting a 15% upside potential. So let's break down whether this stock deserves a spot in your portfolio. Healthpeak Properties is a fully integrated REIT specializing in healthcare real estate across the United States. The company operates through three main segments: medical office buildings serving outpatient facilities, life science properties housing research labs, and senior housing, including retirement communities. In 2023, the company merged with Physicians Realty Trust, expanding its portfolio to over 52 million square feet. Today, Healthpeak maintains a strong presence in high-growth markets like Dallas, Houston, Nashville, Phoenix, and Denver. The company's strategic focus is on healthcare discovery and delivery sectors which benefit from powerful secular growth trends, including an aging population and advancing medical technology. Let's examine the company's financial performance. Over the last 12 months, Healthpeak generated $2.8 billion in revenue. However, here's an important caveat. The company reported a net loss of $38.94 million, translating to a loss per share of negative $0.06. This isn't uncommon for REITs, as their primary income derives from rental revenue and property operations, with accounting depreciation often creating paper losses. The company's gross margin stands at a healthy 59.74%, though the operating margin is 17.94% and profit margin is negative 1.36%. EBITDA of $1. $51 billion demonstrates strong operational strength despite the accounting loss. When analyzing REIT stocks, traditional PE ratios are less relevant than metrics like price to FFO, funds from operations, and price to AFFO, adjusted funds from operations. Healthpeak's price FFO ratio sits at 10.04, while the price AFFO ratio is 11.19. The PS ratio is 4.44, and PB ratio is 1.63. The forward PE of 62.20 appears elevated, while the enterprise value to EBITDA ratio of 14.53 suggests moderate valuation. The PEG ratio of 23.44 indicates the stock may be trading at a premium relative to its growth expectations. The POCF ratio of 10.17 shows the company is reasonably valued compared to its operating cash flow generation. Now let's examine the company's financial health. Healthpeak holds $98.78 million in cash but carries $9.44 billion in total debt, resulting in a net debt position of negative $9.34 billion or negative 13.20 per share. While this debt level appears high, it's standard for REITs that use leverage to acquire properties. The current ratio of 3.65 is excellent, indicating the company can easily meet its short-term obligations. The debt-to-equity ratio of 1.14 remains within manageable parameters. The interest coverage ratio of 1.70 is somewhat tight, but acceptable. Book value per share stands at $10.93 compared to the current price of $17. Looking at efficiency metrics, the picture is concerning. Return on equity, ROE, is negative at minus 0.12%, while return on assets, ROA, is just 1.59%. Return on invested capital, ROIC, stands at 1.75%, and return on capital employed, or ROCE, is 2.62%. These low-return metrics suggest the company isn't efficiently converting capital into profits. Revenue per employee is $7.24 million, reflecting the capital-intensive nature of real estate. With only 387 employees, the company operates with a lean organizational structure. asset turnover of 0. 14 is typical for property businesses as real estate generates steady but moderate returns relative to asset value. Dividend, the main attraction. Here's where Healthpeak really shines, the monthly dividend. The company pays an annual dividend of $1.22 per share, yielding an attractive 6.84% at the current price. If you invest at $17 per share, you'll receive 6.84% annually in dividend income paid out monthly for consistent cash flow. The next ex-dividend date is December 19, 2025. Monthly distributions provide regular passive income unlike traditional quarterly payers. However, note that payout ratio data isn't available and the buyback yield is negative 9.31%, meaning the company is issuing shares rather than repurchasing them. The shareholder yield is negative 2.30%. For income-focused investors, this dividend yield is compelling. The company has 707.95 million shares outstanding, with share count increasing 9.31% year over year, indicating dilution. The float is 692.08 million shares. Institutional ownership stands at an impressive 96%, suggesting major funds and institutions have confidence in the stock. Insider ownership is minimal at just 0.32%. Short interest is 18.65 million shares, representing 2.63% of outstanding shares. The short ratio is 1.89 days. High institutional ownership is generally positive, as it indicates professional investors have conducted thorough due diligence before investing. Cash flow reveals a company's true earning power. Healthpeak generates operating cash flow of $1.24 billion, demonstrating strong operational performance from rental income and property operations. Unfortunately, capital expenditures and free cash flow data aren't available, making complete analysis challenging. The POCF ratio of 10.17 means the stock trades at 10 times its operating cash flow. For REITs, cash flow and FFO/AFFO metrics are more important than traditional earnings. Working capital of $985.87 million is positive, indicating good liquidity. From a technical perspective, the stock has a beta of 1.10, meaning volatility is similar to the broader market. Over the past 52 weeks, the stock has declined minus 16.75%, a bearish trend. The 50-day moving average is $18.29, and the 200-day moving average is $18.32. With the current price at $17, the stock is trading below both moving averages, technically a weak position. The RSI Relative Strength Index of 49.61 is neutral, neither overbought nor oversold. Average daily volume of 7.7 million shares provides decent liquidity. The company's last stock split was in March 2004 at a 2-to-1 ratio. Wall Street analysts are moderately bullish on Healthpeak. 11 analysts cover the stock with a consensus buy rating. The average price target is $20.55, representing 15.19% upside from current levels. Revenue growth is forecast at 31% annually over the next 5 years, indicating steady expansion. However, EPS growth forecast is negative at minus 3.31%, which is concerning. Multiple analysts, including Evercore ISI, have issued buy ratings. The healthcare real estate sector benefits from secular tailwinds, including aging demographics and medical innovation. Expected merger synergies range from $40 to $60 million annually. Every investment carries risks, and Healthpeak has several concerns. First, the company is currently unprofitable with negative net income. Second, the high debt load of $9.44 billion is interest rate sensitive. Rising rates increase financing costs. Third, low return ratios, ROE negative 0.12%, ROIC 1.75%, indicate inefficient capital allocation. Fourth, share dilution is occurring with a 9.31% increase in outstanding shares. Fifth, the forward PE of 62.20 suggests expensive valuation. The interest coverage ratio of 1.70 is tight. Healthcare real estate faces regulatory risks and changes to reimbursement policies. Real estate cycles and occupancy rates also present ongoing challenges. So, who is this stock right for? Income-focused investors seeking regular monthly dividends will find the 6.84% yield attractive. Long-term investors who believe in the healthcare sector's growth story may find value here. Investors seeking REIT diversification could add this to their portfolio. However, growth investors looking for high capital appreciation should look elsewhere, given the negative EPS growth forecast. Risk-averse investors may be concerned about the high debt levels. New investors should note the company is currently operating at a loss and valuation metrics send mixed signals. The final verdict on Healthpeak Properties is mixed. On the positive side, high dividend yield of 6.84%, strong institutional ownership of 96%, solid cash flow of $1.24 billion, Analyst consensus buy rating with a 20.55 target, and secular growth tailwinds in healthcare real estate. On the negative side, the company is currently unprofitable, carries high debt of $44 billion, shows low return metrics, experiences share dilution, and trades near its 52-week low. If you prioritize dividend income and can hold long-term, $17 may represent a reasonable entry point with a target of $20.55. However, better capital appreciation opportunities likely exist elsewhere. Make decisions based on your risk tolerance and investment goals. This video is for informational purposes only and not financial advice. Always conduct your own research or consult a financial advisor before investing. Thanks for watching this complete analysis of Healthpeak Properties. If you found this video helpful, please like, share, and subscribe to the channel. Drop a comment below telling me what you think about this stock and which stock you'd like me to analyze next. Until next time, happy investing.